Preparing for a financial planning and analysis FP&A at Accenture interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is the role of FP&A in a company like Accenture? FP&A connects accounting results to forward-looking business decisions. I see the role as owning budgets, forecasts, management reporting, and analysis that explains what is driving performance. In an Accenture environment, that also means partnering with delivery, finance operations, and client teams to translate data into actions. Good FP&A does not just report variances. It helps leaders decide where to invest, where to control cost, and how to protect margins. While answering, focus on FP&A as a forward-looking finance function, covering budgeting, forecasting, reporting, business partnering, decision support, and how Accenture's client service model makes commercial insight especially important. Question 2. What is the difference between budgeting and forecasting? Budgeting sets the annual financial plan. Forecasting updates that plan as reality changes. A budget is usually approved before the year starts and becomes the baseline for targets, hiring, spend, and margin expectations. A forecast is more dynamic, often monthly or quarterly, and incorporates actual results, pipeline, utilization, pricing, and cost trends. In interviews, I would stress that forecasts should be unbiased, action-oriented, and owned jointly by finance and business stakeholders. Make sure to cover the purpose, timing, ownership, and flexibility of budgets versus forecasts, and emphasize that forecasting should reflect current business realities rather than simply restating the annual budget. Question 3. How do the three financial statements link together in an FP&A model? The three statements connect through profit, cash, and balance sheet movements. Revenue and expenses drive net income on the income statement. Net income starts the cash flow statement. Then we adjust for non-cash items and working capital. Ending cash flows into the balance sheet, while retained earnings captures net income less dividends. For FP&A, this linkage matters because a revenue plan may look good, but it can still create cash or working capital pressure. In your answer, talk about net income, cash flow adjustments, working capital, ending cash, retained earnings, and why integrated statements help FP&A evaluate profitability, liquidity, and balance sheet impact. Question 4. Walk me through how you would perform variance analysis for monthly results. I would start by confirming the baseline, budget, latest forecast, and prior year. Then I would identify the largest variances by revenue, gross margin, operating expense, and headcount. The key is separating what happened from why it happened, such as volume shortfall, pricing pressure, delayed hiring, FX, or timing. After that, I would quantify the run rate impact and recommend actions, because variance analysis is only valuable if it improves decisions. Be sure to mention comparing actuals against budget, forecast, and prior period, isolating price, volume, mix, timing, and one-off impacts, then translating findings into actions for business leaders. Question 5. How would you forecast revenue for a consulting and technology services business? For a services business, I would build revenue from operational drivers, not just historical growth. I would start with contracted backlog, then layer in probable pipeline based on stage-weighted win rates and expected start dates. Next, I would test capacity using billable headcount, utilization, billing rates, and delivery ramp assumptions. For Accenture, I would also consider consulting versus managed services mix, contract renewals, and currency. The final forecast should reconcile commercial demand with delivery capacity. Focus on revenue drivers such as signed backlog, sales pipeline, win rates, billable headcount, utilization, pricing, project duration, contract type, renewals, and seasonality in a services-based business. Question 6. What are the main drivers of profitability in a professional services business? Profitability in professional services is heavily driven by people economics. The biggest levers are utilization, billing rates, staffing mix, salary cost, and delivery efficiency. For example, Higher utilization improves margin because fixed employee cost is spread across more billable hours. Pricing and scope management also matter. Underpriced work or unmanaged change requests can erode profit quickly. I would also watch pyramid leverage, offshore delivery mix, subcontractor usage, and SG&A discipline. In your answer, cover utilization, billing rates, project staffing mix, delivery efficiency, subcontractor cost, salary inflation, pricing discipline, scope control, and the link between revenue growth and operating leverage. Question 7. If your forecast is significantly different from actual results, how would you investigate it? First, I would check whether the actuals are complete and mapped correctly, because data issues can look like business issues. Then I would compare the forecast assumptions against the actual drivers: volume, pricing, timing, headcount, project starts, expenses, and FX. I would separate timing differences from true run rate changes. After discussing with business owners, I would update the forecast methodology if needed and document the lesson learned so the next cycle becomes more accurate. Make sure to cover data validation, assumption review, business driver analysis, timing versus permanent variance, stakeholder discussions, forecast bias, and process improvements to prevent recurring misses. Question 8. Why are accruals and prepaids important for FP&A? Accrual and prepaids help match expenses to the period that benefits from them. For FP&A, that matters because monthly actuals are the base for run rate analysis and forecasting. If a large vendor invoice is missing, expenses look artificially low. If an annual software payment is expensed all at once, the month looks distorted. I would work closely with accounting during close to understand these items and normalize results before presenting performance trends. Be sure to explain matching principle, timing differences, clean monthly results, forecast accuracy, expense run rates, and how FP&A partners with accounting during close to avoid misleading variances. Question 9. How would you build an operating expense forecast? I would split operating expenses into meaningful driver groups. People-related costs would be based on headcount, compensation, benefits, hiring timing, and attrition. Vendor and technology costs would be tied to contracts, usage, renewals, and inflation. Travel, training, and marketing would require business input because they are more discretionary and seasonal. I would compare the forecast to historical run rates and budget, then challenge whether each spend category supports revenue growth, delivery quality, or efficiency. In your answer, discuss fixed versus variable costs, headcount-linked expenses, vendor contracts, inflation, seasonality, committed spend, discretionary spend, historical trends, and alignment with business priorities. Question 10. How do you approach headcount planning in FP&A? Headcount planning should connect workforce capacity to the financial plan. I would start with current employees, approved open roles, expected start dates, attrition assumptions, salary levels, bonus, benefits, and location mix. In a services company, I would also connect headcount to billable capacity, utilization, and project demand. The risk is planning revenue growth without enough delivery capacity, or hiring too early and pressuring margins. A good model shows both cost and capacity impact. Focus on approved positions, hiring pipeline, attrition, start dates, salary bands, utilization, capacity planning, labor cost, business demand, and how headcount assumptions affect revenue and margins. Question 11. What working capital metrics would you monitor in an FP&A role? I would monitor days sales outstanding, receivables aging, unbilled revenue, deferred revenue, and payment terms. In project-based or managed services businesses, billing milestones and collection timing can create a gap between recognized revenue and cash. That is why FP&A should not stop at operating profit. If DSO rises or unbilled balances grow, it may signal delivery documentation issues, client disputes, or contract complexity. Strong working capital management protects cash flow and reduces financing pressure. Make sure to cover DSO, accounts receivable aging, unbilled revenue, deferred revenue, payables, billing milestones, collections, cash conversion, and why working capital matters beyond accounting profit. Question 12. What would you include in an FP&A dashboard for senior leadership? A senior leadership dashboard should be concise, visual, and decision-oriented. I would include revenue, gross margin, operating margin, cash flow indicators, headcount, utilization, forecast accuracy, pipeline coverage, and key risks or opportunities. Each metric should show actuals versus budget, latest forecast, and prior year where useful. I would avoid clutter and add short commentary explaining the drivers. The goal is not to show every number. It is to highlight where leaders need to act. Be sure to mention executive-level KPIs, actual versus forecast trends, revenue, margin, cash, headcount, utilization, pipeline, risks, commentary, visual clarity, and actionable insights rather than excess detail. Question 13. What makes a financial model reliable and easy to use? A reliable model is transparent, flexible, and easy to audit. I prefer clear tabs for inputs, calculations, outputs, and checks, with assumptions separated from formulas. Formulas should be consistent across rows and columns, and any hard codes should be clearly labeled. I would include error checks, version control, and documentation of key assumptions. For FP&A, usability matters because models are often shared with stakeholders who need quick answers under tight timelines. In your answer, cover clear structure, separated inputs and calculations, consistent formulas, checks, version control, assumptions documentation, scenario flexibility, auditability, and user-friendly outputs. Question 14. How would you use scenario analysis in FP&A? Scenario analysis helps management prepare for uncertainty instead of relying on one forecast. I would build a base case, upside case, and downside case around the most important drivers, such as revenue growth, pricing, utilization, wage inflation, FX, or client renewals. Then I would quantify the impact on margin, cash, and headcount needs. The best part is linking each scenario to actions, like delaying hiring, accelerating collections, reprioritizing spend, or investing behind stronger demand. Make sure to discuss base, upside, and downside cases, key business drivers, sensitivity testing, management actions, risk planning, and how scenarios support decisions under uncertainty. Question 15. How would you analyze client or project profitability? I would start with contract revenue and compare it to direct delivery costs, including labor, subcontractors, travel, tools, and other project expenses. Then I would analyze gross margin by client, project, service line, and contract type. The drivers usually include staffing mix, utilization, billing rates, delivery delays, and scope creep. I would be careful with overhead allocations so the analysis remains fair. The output should identify margin leakage and recommend pricing, staffing, or operational fixes. Focus on revenue, direct labor, subcontractors, project expenses, utilization, billing rates, scope changes, allocation of overhead, contract type, margin leakage, and actions to improve profitability. Question 16. If leadership asks you to reduce SG&A costs by 5%, how would you approach it? I would not start by applying a flat 5% cut everywhere. I would segment SG&A into fixed, committed, and discretionary spend. Then review vendors, travel, events, software, contractors, and duplicative activities. I would also assess which costs support revenue generation, delivery quality, or regulatory needs. After discussing options with owners, I would propose targeted reductions with timing and risk. Finally, I would track whether the savings actually flow through to the profit and loss. Be sure to cover spend segmentation, fixed versus discretionary costs, vendor review, ROI assessment, prioritization, stakeholder input, avoiding cuts that damage growth, and tracking savings realization. Question 17. What is zero-based budgeting, and when would it be useful? Zero-based budgeting means building the budget from the ground up instead of starting with last year's spend plus inflation. Each cost must be justified based on the activities and outcomes it supports. It is useful when a company wants to reset its cost base, remove legacy spend, or improve accountability. The downside is that it takes more time and stakeholder effort. I would use it selectively for discretionary areas where cost visibility and prioritization matter most. In your answer, explain building budgets from justified activities rather than prior year spend. Benefits: drawbacks, use cases, stakeholder effort, and how it can improve cost discipline. Question 18. How does FP&A work with accounting during the monthly close? FP&A and accounting need a tight, close partnership. Accounting owns the books, while FP&A explains the business story behind the numbers. During close, I would review actuals, accruals, prepaids, reclasses, cost center coding, and unusual entries. If something looks inconsistent with business activity, I would raise it before reporting goes out. After close, FP&A translates the numbers into variance commentary, forecast implications, and management actions. Speed is important, but accuracy comes first. Make sure to cover reviewing actuals, accruals, reclasses, cost center mapping, variance explanations, close timelines, communication, and ensuring reporting is accurate before management review. Question 19. What KPIs would you track for a consulting or managed services business? For a consulting or managed services business, I would track both financial and operating KPIs. Financial metrics include revenue growth, gross margin, operating margin, cash flow, DSO, and client profitability. Operating metrics include bookings, backlog, pipeline coverage, win rate, billable headcount, utilization, average billing rate, attrition, and contract renewals. These metrics connect demand, delivery capacity, and financial outcomes. If utilization falls or pipeline weakens, it usually shows up later in revenue and margin. Be sure to mention revenue growth, bookings, backlog, pipeline coverage, utilization, billable headcount, average billing rate, gross margin, attrition, DSO, contract renewals, and client profitability. Question 20. Explain EBITDA, operating income, and net income in simple terms. EBITDA is earnings before interest, taxes, depreciation, and amortization, so it shows profit before financing, tax structure, and major non-cash charges. Operating income goes a step lower and includes depreciation and amortization, making it a stronger measure of core operating profitability under accounting rules. Net income is the bottom line after interest, taxes, and non-operating items. In FP&A, I would use all three, but I would choose the metric based on the decision being made. Focus on what each metric includes or excludes, why EBITDA approximates operating cash generation, why operating income reflects core operations, and why net income captures below-the-line items. Question 21. How can foreign exchange movements affect FP&A reporting for a global company? FX can affect reported results even when the underlying business is stable. Translation impact occurs when foreign subsidiaries' results are converted into the reporting currency. Transaction impact happens when revenues and costs are denominated in different currencies. In FP&A, I would separate constant currency performance from FX movements so leaders can see true operational trends. For a global company like Accenture, forecast assumptions around exchange rates, offshore delivery costs, and client billing currencies can materially affect margins. In your answer, discuss transaction versus translation effects, constant currency reporting, revenue and cost exposure, hedging awareness, forecast assumptions, and communicating FX impact separately from operational performance. Question 22. How would you improve or automate an FP&A reporting process? I would first map the current process, including data sources, manual steps, owners, timing, and recurring errors. Then I would standardize definitions and templates before automating, because automation of a bad process just makes bad reporting faster. Depending on the environment, I might use Power BI, Power Query, Anaplan, SAP, Oracle, or workflow tools. I would build controls and reconciliation checks into the process. The aim is faster reporting, fewer errors, and more time for analysis. Make sure to cover process mapping, data source validation, standardization, automation tools, controls, dashboarding, reducing manual Excel work, stakeholder requirements, and maintaining accuracy during transformation. Question 23. Tell me about a time you had to challenge a business stakeholder's forecast assumption. I would handle this by being evidence-based, not confrontational. If a stakeholder assumed aggressive revenue growth, I would compare it with pipeline conversion, historical win rates, staffing capacity, and client start dates. Then I would show the risk quantitatively, such as the margin impact if hiring happens before revenue. My goal would be to align on a realistic forecast, not to win an argument. Strong FP&A builds trust by being objective, commercial, and solution-oriented. Be sure to structure the answer with situation, analysis, stakeholder management, evidence used, how you challenged professionally, the final decision, and what the business impact was. Question 24. Revenue is up 10%, but operating profit is down. What could be causing this? Higher revenue does not automatically mean higher profit. I would check whether growth came from lower margin contracts, pricing concessions, higher subcontractor usage, or a less favorable delivery mix. Wage inflation, low utilization, project overruns, and scope creep can also pressure gross margin. Below gross profit, SG&A may have grown faster than revenue, or there may be one-time costs. I would bridge revenue to operating profit step by step to identify whether the issue is commercial, operational, or cost-related. Focus on margin mix, pricing, wage inflation, utilization, delivery overruns, subcontractor costs, SG&A growth, one-time costs, FX, acquisition integration, and distinguishing revenue quality from revenue quantity. Question 25. Why do you want to work in FP&A at Accenture? I am interested in FP&A at Accenture because it combines finance, technology, and business partnering at global scale. The work is not just producing reports, it is helping leaders understand performance, manage costs, forecast demand, and make better commercial decisions. Accenture's exposure to consulting, managed services, digital transformation, and complex clients makes the finance role especially interesting. I would bring strong analytical discipline, curiosity, and stakeholder communication to turn financial data into practical business insight. Make sure to connect your motivation to Accenture's global scale, technology and consulting exposure, data-driven finance transformation, business partnering, learning culture, and your interest in turning numbers into decisions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.